I call this the duck bill effect. I'm a terrible artist, so give me some leeway here, but I have 0 to 30 years, right? The basics is that we buy a house and we make payments over time, right? So as we make payments, and what you'll see is if you look at what's called a loan amortization schedule, over a longer period of time, more and more and more of that payment goes towards the principal versus the interest, right? The lower the interest rate, the more expeditious that tends to happen. But even today at 7%, or even if you have, let's just say at 8% locked in because you bought at the peak of a couple, this last year, you can still understand that you pay more interest at the beginning versus principal. But this accelerates over time. And if you refinance, obviously you start this clock over and you're paying as little as possible. So you want to be careful and be strategic about the refinances. That's something that a good loan officer can do, and Rachel can talk to you about that. But once you understand that this part of the lower part of the duck bill exists, and that the kind of a similar concept is with appreciation, the value of the home, right? And the reason I have this initial gap is because obviously you typically have a down payment, and so you automatically have a gap. If it's 0, then it starts together closer. If it's a larger down payment, it starts with a bigger gap here. But as you play this game, this gap gets longer and longer and longer.